Hi everyone, welcome to today's video. In today's video, we'll be discussing about a question that came from one of my friends and subscriber. So in this video, we'll be trying to address that particular question. So now let's first jump into the question. So the question is about this particular artificial intelligence ETF. The ticker symbol is AIQ as you can see here. And my friend is also asking about the semiconductor ETF. So these are the two things that I will be discussing in today's video. At the end of this video, I'll also be sharing a framework that you can use to compare any of the ETFs. Let's get started. The standard disclaimer, the information that is presented here is only for informational educational purpose. Please consult with your own financial advisor before you make any financial decision, and this cannot be considered as financial advice. This is just my opinion and how I think about evaluating ETFs. So in this particular video, I'll share about how I'm going to evaluate those two particular ETFs. So basically, I'll be sharing my thinking process when I'm going to compare these ETFs. So you can use a similar approach for comparing any other ETFs. So the first thing that I would do is compare the ETFs against the index. Like you can compare the performance against the index. Now the two most popular indices are the S&P 500 index and QQQ, which is the NASDAQ 100 index. So in some other countries, this could be NDQ or NDX. But you can just compare them with S&P 500 ETF that might be available in your country, and QQQ is the NASDAQ 100 index. So these are the two most popular and biggest indices among the ETF investors. So now when we look at the 1 year performance, all three of them fall in the 33 to 35% bracket. Like AIQ has slightly outperformed QQQ and S&P 500 index in the 1 year time frame, primarily because the AI trend is very hot right now, and investors like private investors like venture capitalists as well as in the public markets, they are all chasing AI companies, especially the chip manufacturers like NVIDIA, and this is the reason why the artificial intelligence ETF has slightly done better than the other indices. Now when we look at the 3 year time frame, you can see that the AIQ, that is the artificial intelligence ETF, has slightly underperformed when we zoom out. So this is why we shouldn't be relying just on 1 year data or 1 year performance, because we do not know when the trend will come to an end. I'm not saying the AI trend is a very short-term trend or short-term fad. It could last for a few years or few decades as well. Now when we look at the 3 year time frame, we can see that AIQ has slightly underperformed IVV, the S&P 500 and QQQ. Now, when we look at the 5 year time frame, we can see that NASDAQ 100 has outperformed both S&P 500 ETF as well as the artificial intelligence ETF. One of the reasons why the NASDAQ 100 index could have outperformed S&P 500 is because of a slightly lower concentration and a high concentration of tech companies. Now, what do I mean by lower concentration of companies is that the NASDAQ 100 has only 100 companies, whereas the S&P 500 has 500 companies. So the money that you invest is too diversified in S&P 500 index, whereas in NASDAQ 100, it is concentrated only in 100 companies. So each company would get based on the market weight, they would have a allocation. That could be one reason. And the other reason is a high concentration of tech-related companies, which are software, enterprise software, or chip-related companies like NVIDIA. They have a higher weightage in the QQQ. So that could be one more reason. So when we look at AIQ and versus the index, we can see that the NASDAQ 100 has clearly outperformed the AIQ index. Now, one more important thing that you need to consider is the expense ratio of these ETFs. So expense ratio is the fees that you pay to the fund company for each and every year. So you can see that the expense ratio is also slightly on the higher side when you compare it with the index funds. So index funds do not have any active managers, so they have relatively or very low fees because they are just going to track the index or the market index. So there is no human discretion or an active manager playing an active role in managing it. So there is a very low expense ratio, and this is a fees that you pay each and every year. So when you're paying lower fees, it's like you're saving on your amount, and it returns like you are allowing your money to compound at a very more better rate. When you are paying a higher expense, it means that out of your investment you are paying a certain amount as a expense fee. So it is a cost for that is incurred for managing that money. So you also need to consider what is the expense ratio of the ETF that you are investing in. Now let's come to the second ETF, which is the semiconductor ETF, Van Eyck SMH, which is the semiconductor ETF. Now when we look at SMH, it has a relatively lower expense ratio as well when compared to AIQ, but it is still slightly higher than QQQ and IVV, which is the S&P 500 and NASDAQ 100 index. But when we look at the performance over the last 5 years, we can see that the Van Eyck Semiconductor ETF has done significantly better, in which case it is, I feel that in my opinion, it is slightly okay for this expense ratio and for this returns, and like even for the 3-year returns and the 1-year returns, the semiconductor ETF has done really well. Now you might ask, like, why is it that semiconductor ETFs are doing well? Now, because of this AI trend, there is a lot of significant investments that goes into the data centers as well as the chips. Basically, the market leader in this one is NVIDIA. The most of these returns are because of NVIDIA. Like, it has almost a 20% weightage, or close to 19 to 20. You can check in you would see that NVIDIA has a very high percentage or very high weight in this, and that is one of the biggest reasons why this has performed really well. When we look at this index and SMH, we can see that though the expense ratio is slightly higher, but the performance is really way ahead of AIQ and the S&P 500 index and NASDAQ 100 index. Now let's go into this framework that you can use. Now the first thing that we looked at was comparing the performance of the ETF that you're considering versus the index funds. Now the second thing that you need to look at is the expense ratio, like how expensive it is to invest in that, because expense ratio, or the expense, is you're going to be paying each and every year for the because you're going to be invested in ETFs for a long period of time. It's not like you're trading into stocks or investing in stocks where you buy and sell frequently, but ETFs, investors are mostly like buy and hold for a long period of time, because you're holding a large collection of companies. So there is no point in trading in and out of ETFs. That's the reason why we need to consider the expense ratio like this, because this is an expense, or the cost that is going to come out of your pocket. So you need to consider how expensive it is. Now there are also some other factors that you need to consider. Now one thing is the liquidity or the trading volume, because some of the ETFs might have low liquidity, in which case the bid versus ask spread might be higher. I always suggest that you always use limit orders when you are placing ETFs, because of this liquidity and trading volume and bid versus ask spread. Something like S&P 500 or a NASDAQ 100, you wouldn't have a much difference between versus ask spread. But when you're going into thematic ETFs like AIQ, that is artificial intelligence ETF, or semiconductor ETFs, the trading or liquidity volume is not as high as the index ETFs. So in that case, you need to consider the trading liquidity and trading volume. The next one that you need to focus on is, these are all slightly minor factors that you can consider while investing. Geographic focus, which is whether the ETF that you're investing, or the thematic ETF, or any ETF that you're investing, has a very specific geographic focus, or it has a very country specific risk. Now suppose if you are investing in ETFs that are like India specific ETFs or Australia specific ETFs, those might have country specific risk, and there's some things like a global one might have risk spread across the countries. The other one is when you're investing in international ETFs, like suppose if you are from Europe or Australia and then you're investing in a US based ETF, you need to consider the currency hedging as well. The other thing that you need to consider is the tracking error. Now, semiconductor ETF actually tracks the semiconductor index. So the index would be rebalanced, and then there will be some kind of a tracking error, because the fund manager has to, or the fund company has to replicate that particular index. So in which case there will be a slight error or tracking error. It's called as a tracking error in ETFs. This is also something you can consider when you're considering similar ETFs. Suppose if you are considering semiconductor ETFs from different providers, you can consider how different fund houses have different tracking errors. The next other factors that you need to consider is the tax efficiency. Now, if you're investing in international ETFs, like suppose if you're from Europe or Australia and then you're investing in US based ETFs, these are considered as you need to consider whether for tax purposes, whether they are domiciled in your own country or whether they are considered as foreign asset. This is a big factor because depending upon where it is tax domiciled, you will be taxed differently, because domestic assets are taxed differently and foreign assets are taxed differently. So this is also another big factor, though I put it in other factors. Tax efficiency, and whether the ETF that you're investing, international ETF, whether you're considering is domiciled in your own country or whether it is considered as a foreign asset from your from the country that you're investing in, is a very important factor as well, because the tax percentage varies. There's a difference between how domestic assets are taxed and how foreign assets are taxed. So this will be a big consideration when you are going to, like, down the lane, like 10-15 years or 20 years down the lane, when you're going to sell the ETF for any of your big purchases, like you're buying a house or something. In that case, the tax would be applied because we realized your gains and you're selling out of an asset. So in that case, how it is taxed is also a very, very important factor. So when you are considering an ETF, always consider the tax efficiency. So if I have to take three factors, first important factor is how does it compare with index ETFs, because index ETFs have lower expense ratio. The second one is how the expense ratio is a second important factor, like what is the cost involved in investing in this particular ETF. And the third important factor is the tax efficiency. And you can also consider other factors like currency hedging, whether geographic focus in terms of risk and all other things. Got some framework for investing in ETFs, and do let me know if you have any other follow-up questions on ETFs or any other assets, and I will try to make a video on that. Thank you for watching. Please do consider subscribing to this channel if you have learned something new today. Thank you.